Welcome back, everyone. Today, we're going to discuss a topic that might sound counterintuitive at first: how to profit from debt. Now, before you get worried, we're not advocating irresponsible borrowing or getting into financial trouble. Instead, we'll explore smart strategies that can turn debt into a tool for building wealth and financial prosperity. So, if you're interested in learning how to leverage debt to your advantage, stay tuned. Number 1. Understanding good debt. When considering good debt, it's essential to understand the long-term benefits it can provide. Take mortgages, for example. While they may seem like a significant financial commitment initially, they allow you to build equity in a property. As property values rise over time, you gain a valuable asset that can potentially appreciate substantially. Similarly, business loans can be a catalyst for entrepreneurial success. They provide the necessary capital to start or expand a business, allowing entrepreneurs to invest in resources, technology, and marketing efforts. With the right strategy and a well-executed business plan, these investments can lead to significant profits and business growth. Moving on to student loans, it's crucial to view them as an investment in your future earning potential. Higher education often leads to specialized knowledge and qualifications, making you more desirable to employers and potentially opening doors to higher-paying career opportunities. While student loan debt may seem daunting at first, the increased earning potential can more than compensate for the initial financial burden. In essence, good debt is about using borrowed funds to invest in assets or opportunities that have the potential to grow your net worth and improve your financial situation in the long run. However, it's crucial to approach these investments with careful consideration and a well-thought-out plan. Assess the potential risks and rewards. Ensure you can comfortably manage the debt, and align your borrowing decisions with your financial goals. Remember, not all debt is created equal, and understanding the distinction between good and bad debt is fundamental to achieving financial success. By leveraging debt responsibly and strategically, you can create a pathway to wealth and financial prosperity that aligns with your aspirations. So, whether it's a mortgage, a business loan, or a student loan, make sure to evaluate the potential benefits and weigh them against the associated costs before making any financial commitments. Number 2. Building creditworthiness. Building and maintaining a strong credit score is like laying a solid foundation for your financial future. A good credit score can open doors to better financial opportunities and lower borrowing costs. One essential tip is to pay your bills on time consistently. Timely payments demonstrate reliability and financial responsibility to potential lenders. Additionally, keep your credit utilization low by managing your credit card balances wisely. Aim to use only a small portion of your available credit, as high utilization can signal financial distress to creditors. Avoid taking on unnecessary debt that may strain your financial resources and lead to missed payments. Regularly review your credit report for errors and inconsistencies, as inaccuracies could negatively impact your score. By proactively monitoring and rectifying any discrepancies, you can maintain a more accurate representation of your creditworthiness. Lastly, be patient and stay disciplined. Building creditworthiness takes time, but consistently demonstrating responsible financial behavior will eventually yield positive results. Remember, a strong credit score is not just about obtaining favorable borrowing terms. It's about having greater control over your financial destiny and the ability to make informed decisions for a more secure future. Number 3. Using debt to invest. Investing with debt can be a powerful wealth-building strategy, but it's essential to approach it with caution and expert guidance. Diversification is a fundamental principle to mitigate risks. Allocating borrowed funds across different asset classes, such as stocks, bonds, and real estate, helps spread risk and enhances the potential for long-term gains. Before taking on any debt for investment purposes, conduct thorough research and analysis. Consider the historical performance of the assets you intend to invest in, as well as their growth prospects. Consult with a financial advisor to gain valuable insights and tailor an investment plan that aligns with your risk tolerance and financial goals. Using debt to invest requires a long-term perspective and discipline. Market fluctuations can affect the value of investments, so it's crucial not to panic during temporary downturns. Instead, focus on the long-term potential and stick to your investment strategy. Furthermore, remember that leveraging debt amplifies both gains and losses. While it can boost returns during prosperous times, it can also exacerbate losses when the market is down. Carefully assess your ability to withstand potential downturns and have a contingency plan in place. Investing with debt isn't for everyone, and it's essential to gauge your financial stability and risk tolerance before embarking on this strategy. If executed wisely, however, leveraging debt to invest can accelerate your journey toward financial independence and prosperity. As always, informed decision-making, coupled with expert advice, will pave the way to a more secure financial future. Number 4. Refinancing and debt consolidation. Refinancing and debt consolidation can be game changers for individuals seeking to gain better control over their financial obligations. Refinancing is a strategic move that enables borrowers to take advantage of lower interest rates, reducing the overall cost of borrowing. By replacing high-interest loans with more favorable terms, you can save money in the long run and potentially accelerate your debt repayment journey. Debt consolidation, on the other hand, streamlines your financial responsibilities by combining multiple debts into a single, manageable loan. This not only simplifies your financial life, but it can also lead to more favorable interest rates, further reducing the financial strain. With a single monthly payment to focus on, you can allocate more resources toward debt reduction and financial goals. However, it's crucial to approach refinancing and debt consolidation with a well-informed plan. Understand the terms and fees associated with these options to ensure they genuinely benefit your financial situation. Remember, while these strategies can be advantageous, they are not magical solutions to debt problems. Responsible financial behavior and budgeting are still essential components of successful debt management. When considering refinancing, compare different lenders and loan options to secure the best terms. For debt consolidation, evaluate the total cost and the potential savings over time. Remember that the goal is to gain control over your debt, reduce interest expenses, and accelerate your journey to financial freedom. It's worth noting that debt consolidation may not be suitable for everyone, especially if you don't address the underlying financial habits that led to multiple debts in the first place. To ensure a successful financial journey, it's essential to commit to responsible spending, budgeting, and saving habits. In conclusion, refinancing and debt consolidation can be valuable tools to manage debt more effectively, but they require careful consideration and a well-thought-out approach. Make informed decisions based on your unique financial situation. Consult with financial experts if needed, and remember that the ultimate goal is to achieve lasting financial stability and peace of mind. Number 5. Knowing your limits. Knowing your financial limits is crucial when engaging in any debt-related strategies. While leveraging debt can be an effective wealth-building tool, it must be done responsibly. Taking on more debt than you can comfortably manage may lead to financial stress and, in the worst cases, financial ruin. One vital aspect of understanding your limits is assessing your debt-to-income ratio. This ratio compares your total debt obligations to your income, giving you an idea of your ability to handle debt payments. Financial experts recommend keeping this ratio below a certain threshold to ensure you have enough disposable income to cover essential expenses and savings. Additionally, it's essential to have a clear repayment plan in place before taking on any debt. Understand how much you need to pay each month and ensure it fits comfortably within your budget. Avoid taking on debt without a concrete plan for repayment, as it can lead to unmanageable debt burdens and potential default. Furthermore, consider your short-term and long-term financial goals. Align your borrowing decisions with these objectives to ensure that debt serves as a means to achieve your aspirations rather than hindering them. Remember, financial situations can change, so be prepared for unexpected events or emergencies. Having an emergency fund can provide a safety net during challenging times, reducing the likelihood of relying on additional debt when faced with unforeseen circumstances. In conclusion, knowing your financial limits is essential for using debt as a profitable strategy. By understanding your debt-to-income ratio, having a clear repayment plan, and aligning borrowing decisions with your goals, you can leverage debt responsibly to create a path toward financial success and security. Be cautious, stay informed, and take measured steps to ensure debt remains a beneficial tool on your journey to financial prosperity. There you have it. smart strategies to profit from debt. Remember, the key is to use debt responsibly and strategically. Don't forget to do your research. Seek professional advice if needed. And most importantly, stay disciplined with your financial decisions. If you found this video helpful, give it a thumbs up and subscribe to our channel for more valuable financial tips. Thanks for watching, and until next time, take care and invest wisely.